Now that we have went through the scenario as well as the question of the January 2025 Paper 2 SAICA Board 1 exam that is called IAC. I want us now to go to suggested solution. So we'll go through suggested solution together, and then I'll highlight the important things that you should think of when you answer the SAICA exam. What I want to say to you now is that even SAICA, they forgot that they've changed the exam name from ITC to IAC. As a result, if you're looking at the suggested solution, it still shows ITC January 2025. However, in 2025 January, they had changed the name from ITC to IAC. So this solution is correct at addressing FreschKart. It's just that the naming was not corrected, or they used the name for the previously exam, which was called ITC. So that is an important thing that I want you to note. I don't want you to say, but why are you showing us ITC? But January, the exam was called IAC. And a matter of there was an error, or SAICA didn't change the solution to IAC from ITC. Okay, let us look at part A and work through it together and analyze to understand why they brought in certain item to the solution. If we're looking at the question, we were asked to look at to discuss the key risk that FreschKart was exposed to on the operating environment before the company shifted to eco-friendly. And we're asked to ignore anything that was addressed by moving to eco-friendly. So if you have any risk that you believe is taking place in the company, but that risk would have been addressed by the shift to eco-friendly or the strategy that was initiated during the year, you do not have to include that risk. If you include that risk, you are running a risk of wasting time plus losing 1 marks for communication, because it simply means you are not thoroughly reading the required. And what is important that you need to remember is that because you would have read the required twice, there is no way that you will miss what you're supposed to do, which is why I had said you need to start reading the required, go to the scenario, then go back to the required again. So by the time you go back to the required again, you will be familiar with what is going on, and the chances of you making errors will be limited. Then let's see on the solution or the suggested solution, what are the points that they have looked at when they were looking at the risk before the shift. But the first part, they look at concentration or market risk, and they spoke about the competitive nature of the retail industry. So if the industry that you're operating in is highly competitive, it becomes very hard to attract and retain customers. Then that raises a risk for the business, because if I came yesterday, maybe tomorrow might decide that I'm no longer going back to to buy my item from FreschKart. However, I'm going to go to Pick and Pay or Checkers. So the challenge of attracting and retain customer in a competitive industry is problematic. Then that raises the risk in terms of making more profit and growing as a business. Number 2, price conscious customer. If you remember, when we were looking at the scenario, we were told that the customers, they are sensitive to price. And we were told, moreover, that they are sensitive to price due to the fact that the interest rate and inflation has went up. So the customer being sensitive to price, it means that we cannot just change the price. If we raise the price of the items that we are selling, we're going to lose the customers, because they will go and buy from other or from competitors. What is the risk? Is that we're going to have to create very little margin. And if we have little margin, we might not be able to cover our fixed cost. Now you can see, now we have an issue. And what is the issue? The issue is that we aren't able to change the price as and when we should because of the sensitivity of the customer. 1.3, it's over reliance on the SAICA. We know that they operate in 3 countries. It's Lesotho, Namibia, and South Africa. However, the majority of revenue is concentrated in South Africa. Since South Africa is not doing so well, that is affecting the entire operation of FreschKart. So it over reliance to certain country, it is a risk. Because now as soon as that country is not doing well, then the whole company is not going to do well. The product is too generalized. So there's a risk that the products they are not offering or their offering is not correct and is not directed to the right customers. And that can lead to stock obsolescence and also poor working environment. So what do they mean by that is that if you're selling a lot of products, you don't focus on certain products. There's a risk that you overstocking and your stock does not address your customer needs. Which is why it's very important that you understand the niche you are going to service and what do they want. So if you look at what they're selling grocery, clothing, and general merchandise. So the product they are selling, it's too general. It's not focusing on certain niche, which raises the risk of stock obsolescence and also poor working management. So what do we mean by poor working management? They could have used the money to buy stock, but they can't sell it because they did not look at the niche or the customers they want to service. So this is the risk as well in terms of market risk. Then exchange rate risk. What is the exchange risk that they're exposed to? So we have said they're operating in several countries, and we spoke about rand appreciation. I am going to dispute 2.1, and the reason I am disputing 2.1 is because of one reason. If Lesotho, Namibia, and South Africa, their currency is the same. The only difference is the naming. For every 1 rand I have in South Africa, I need the same 1 rand in Lesotho and Namibia. So operating in the countries, it's not a problem. However, the currency or exchange rate risk, it arises because they are importing the product outside of South Africa. So that is when the rand depreciate, we end up having a problem. So I agree with the second part, which is because import of some of the products is coming outside South Africa. So as the rand depreciates, we are affected. We're going to end up paying more for stock. And because our customers are price sensitive, we're not going to be able to recover the money that we have paid for our products. Happy with 2.2, but 2.1, I'm really disputing with SAICA because Lesotho and Namibia, as well as South Africa, they are using the same. It's the same. The currency is not the same. The naming is not the same, but the currency is the same. Like it's literally for every 1 rand that I have in South Africa, it's equivalent to what Lesotho and Namibia is requiring. Then we're moving to financial and liquidity risk. Why do we have that? It's because we were told that the interest rate they need to repay their debt is linked. It's a variable interest rate. So why is it a risk? Because any change in interest rate, if the repo rate changes, it affects the company. How it affects it? If the interest rate is went up, will affect the current 10.75% that they have on their current loan. And if it goes down, then it's positive. They are positively affected. They are high gearing. Companies' ability to raise debt is reducing because of the high gearing level. And if you are highly geared, it means even if you do raise the debt, the interest rate you're going to be charged, it's going to be higher compared to when you were not highly geared. Think of you want to go buy a car and you already have so many debt. The bank will see that you are a high risk because any change in your income will significantly influence your repayment. Then the interest rate will be high. So what is the risk to them? They're highly geared. It's hard for them to raise additional finance. And if they are able to raise the additional finance, the risk is that the interest rate will be so high. Obviously, if they're highly geared, it means they might not be able to even pay back the interest rate. What else we saw is that because of the issues that they have and the increase in debt, they also in breach of the debt covenants. So what are the debt covenants? If you go to the bank will tell you, Guti, we want your debt to equity ratio to stay at this point. And if it doesn't, that means you have breached your covenants. So based on the information that we have, is that any further debts the company will have, it will result to an issue with the debt covenants, as well as the increase in debt repayment cost. The other thing that we've seen is that the share price is very volatile. It will also increase our cost of equity and making equity finance more expensive. So as the share price declines, the investors they get worried. Who would want to invest in a company that has a share price that is declining? We've seen in this scenario that it has continuously been declining. We don't know for how long it's going to keep on declining, but it has been declining. And that raises a concern in terms of whether the investors are even going to be interested to invest in our company. And if they do, what is the required rate of return they're going to be looking for? Obviously, they're going to be looking for higher rates of return because of the risk they're going to be taking. When we look at the scenario, we're told that there is a lack of cash flow, which is why they wanted to refinance for the loan that is due on the 30th of September 2025. If the company lacks finance, it means they have a risk of not being able to pay their creditors in time. They have a risk of defaulting on payments suppliers term, and they might be possibly restricted by other suppliers. So do you see, as we go through the solution, all the information I'm talking about here, it's coming from the scenario. Meaning to say, to answer the question, you just need to read and understand the scenario. No matter how easy it is for you to pass the professional exam, because the information you already been provided, you just need to use information that you have been provided and respond in a way that a reader is able to understand what was your train of thought when you were talking or you were responding to the question. Number 4, we have operational risk. What are the risks that we have? We're told about the strikes. We're told that some of the issues that we have is because of the strike due to unhappy workforce. If the workforce is not happy and there's a strike, we know that there's a chance that employees might leave the company. The productivity might be affected. And also it affects the reputation of the company. So that is the operational risk. If there's a strike taking place, think about what will happen with the people. Are they going to keep on staying in the company when they are not happy? What is happening with the productivity? Is the production going well and the continuity of sales going well and the reputation of the company? Are the investor going to be willing to work with us when they know that even the employees that we have employed, they are not happy? Then, change in leave policy and lack of salary increases, it also a problem. The scenario stated that they have decided because of poor performance to change the leave policies. Changing the leave policies, it creates a huge unhappiness from the employees. How is it creating? Because we know that they've decided to change the policy in a way that the employees might not be able to cash back the amount of the leave available. Think of the employee that has decided, Guti, I'm going to keep my leave because next year I need it for my kid that is going to school. So now the policy has been changed. That means they aren't going to gather that money. What's going to happen? They're not going to be happy. So that creates unhappiness of the employees. Another thing that is a risk in terms of operation is because we are using inside drivers for our delivery. So what is the risk? The risk is that the drivers might cause an accident and the accident might be so big that we need to pay for the accident they have caused. They might be injured, we need to pay medical bills. There might be a drunk on the road, we need to pay legal cost. So that is an operational risk. As soon as you have drivers working for you, you ask yourself, as they leave the company, what is going to happen? As soon as they leave the shops, the risk arises. Because as soon as they leave the shop, there's a risk that they might be wrong on the road and then legal cost because we need to support them in court, plus the cost in terms of fixing the car. Or if someone died, the funeral cost, the number of costs that are involved, and that raises the risk or operational risk for the company. Another thing, what happens? Hiring and vetting of drivers. It might happen that when these drivers were hired, they were not vetted or they were not vetted correctly. Next thing, they are stealing our cars. So that is a risk. Losing company cars with no trace, it might be a big risk. Another thing, the company exists in 3 countries. It's Soweto, Namibia, and South Africa. There is a risk that management might not be able to control or be involved on a day-to-day operation. That means that some companies or some divisions or some franchise might not be operating very well, which affects the overall brand of FreschKart. What also is a problem, we know that we are buying some of our products outside South Africa. Any issues in the shipping or shipping delay will affect us in terms of stock availability. Not so long with issues with the transportation, the sea transportation. I think that was 2 years ago, or not even 2 years ago, 1.5 years ago. So that affects us in terms of stock availability. What else is a problem? We know the supply and demand rule. So now if there is an issue in availability of transportation for exported goods or imported goods, then we know what's going to happen. The cost will rise for shipping. What else? We have franchisee. As a result of franchises, there is a reputational risk if they are not delivering the quality product or not upholding to the interests of the company. The other thing, the loyalty program might be too costly. in such a way that when you're looking at cost versus benefit, the cost of having the program is very expensive and might result to the loss to the company. Then we're moving to technology. When you move to technology risk, the risk now is more in line with the app. Why? Because in the app, the customers, they need to put the address as well as the banking details. That exposes the company to hackers or crime, cybercrime. So what happens if you as a customer, your information is hacked? You're going to sue the company. OP would allow that to happen as well. Because we are storing a company in third-party information, we also need to understand the POPI and comply with it. Any non-compliance might result to fines and penalty. Same with payment of information is housed in the application. So that means if the cyber criminals get exposed to our app, we are dead because now the client's information will be stolen and then they can use that information for their own benefit. Then, in terms of not keeping on renewing the app, we are running a risk that it might be obsolete and not user friendly. Then the last part, we are looking at the regulational risk. We know the industry that we are operating in. Any non-compliance in the industry might result to penalties as well as reputational damage. If we don't abide by safety and food standard, you are doomed because now we're gonna have to pay fines and penalties. Then the other things that we have is that we are trading technical insolvents. The company is technical insolvent because the liability exceeded by 75%. So, by Section 22 of the Companies Act, the director should ensure that the company is not technical insolvent. In this case, the directors are still operating the company when it is indeed technical insolvent. So, take us to the end of our risk. So, we've explained a lot, and all that was needed is just 11. So by now you see how easy it is to create the risk. And why it is easy, because we started with the required. And as we go through the scenario, we already knew what we need to take into account or highlight. Now we are done with the first question. Let us look at B. B says critical evaluate the strategic action of FreschKart that FreschKart has undertaken to become more eco-friendly. You recall from the scenario that the CEO decided that they want to move to a more eco-friendly environment. And we're told what they did. But we're told that they decided that they were going to change the packaging from plastic to the more that is created by cotton. We're told that now they're going to use water from the boreholes. We're also told that they're going to buy solar panels. And another thing that they did was to move the inventory or detergents that had previously bought from SIST to another supplier, which was called Pages. So all that information we remember because we had digested it when we were going through the solution. The scenario, apology. So now we need to critical evaluate. You remember when we were going through the required, I said when you are evaluating, you're saying the good things and the bad things. because the bad things might arise and also the good things might be there. So state the points and the obvious based on the scenario. Then now let us look at 1.1. 1.1, you are saying the positive part is that they are showing commitment to the sustainability by reducing the company reliance to non-eco-friendly electricity generation and using sustainable water harvesting techniques. They are also removing plastic bags and not selling non-environmental safe products. We're told that the detergents they were buying, it was not environmental safe. It was not safe because it was contaminating the water and killing the fish. So now we're saying their commitment to sustainability is amazing. So that's the first part of us saying, Guti, what the company directors are doing or what the CEO has invented, it is good. However, by selling the non-environmental safety product to another retailer, that will still go back to the environment. Yes, it might look good in terms of what we did to the company, but the question is, why was it not thrown away? Because we know it's not environmental friendly. Instead, we are selling it to the next supplier. So can you see now how we're taking it? We're saying, yes, it's good that you have decided to take it out of your supply chain. But as far as you took it out of your supply chain, we're going to have to be very serious that, yes, you took it out of your supply chain, but you gave it to the new supplier who is subsequently going to sell it and it's going to destroy the environment. Can you see? And then moving to 1.3, FreschKart could also be said to be assisting in increasing the demand for such products, as this product will now be sold at a cheaper price by pay and choose, which could encourage more customers to purchase them. Thus, this would not seem to align as company values. And exactly what I was saying, they are just reducing the sales price, but that is still going back to the community and it's still going to contaminate water and kill the fish in the sea. You did well by taking out of your supply chain, but you're not doing well for the environment because it's still going to go back to the environment. So if you're looking at that, the company has not done enough to make the sustainability of the economy or the long-lasting products. Okay, what 1.5 is saying the published list of environmental commitment is good. However, the company seems to want to report selectivity on the achievement in this area, which shows a lack of transparency to the public about the company's commitment to real environment changes, and there is no accountability on non-achievement in this area. 1.6. The marketing of the company as an environmental friendly company could be seen as company greenwashing the business given the above. This could be misleading to the public and may create a negative perception for the company, as the company could be said to be doing a rebrand only. So, what are they saying here? They're saying they are releasing the statement that they are environmental friendly, but there is nothing that we are told that they have took the stock that was in their supply chain and gave it to another supplier to sell it out to the environment. And if the public were to know that, they will say this is not an eco-friendly company, but they are just greenwashing. They are lying about saying they are they are eco-friendly. So in terms of alignment with values, yes, they've tried to work on the positive side. However, they've not done enough. The reason we're saying they have not done enough is because why are we sitting here and having a problem? of still having the products that is sold by pay and choose. Then you're going to move to improvement of profitability. The introduction of recycling bin would encourage more customer. Even the non-customers will use the recycle bin. The non-customer, when they use the recycling bin, they will then say, let us go to the shop and see what is inside. So that will improve the profitability. There is, however, no guarantee that the new eco-friendly rebrand could increase demand for FreschKart products and increase company profitability. As we do believe recycling bins will attract more clients, there is no guarantee. We have not sit down and make the calculation to analyze what if we have recycle bin and what if we don't. And then to rebrand the company, it might attract more customer and new customer base, which might increase the profitability of the company. As far as that is our assumption, we cannot guarantee that. Yes, that was the main reason that a CEO wanted that they do a rebranding to increase customer, thereby increasing profitability, but there is no guarantee with that. However, we must remember that when they're introducing the expensive bags from 1.6 Rand to 5 Rand, they're also introducing to CB stores. And the CB stores are pensioner and low class. So that will really affect this class. They might not even come to a store because now they're thinking, I need to pay 5 Rand for the packaging of the products or the stuff that I'm going to be buying. CB stores, they're very sensitive to prices. That means now, for just little things that we have changed, which is changing from 1 Rand 60 to 5 Rand, which might look small, but for CB stores or people that are in pensioners or lower incomes, they might not want to go to the shops where the packaging will be 5 Rand when they can get to other shops like Boxer and pay 1 Rand. Can you see? It is eco-friendly. However, what is our client base is going to be doing with regard to that? Are they going to be happy? Are they going to be attracted? So you need to ask that because that is very important for you to understand. How will my client look at this decision? How will my client receive the decision that I'm making? Okay, then we need to move to 2.5. Investing in solar technology and water harvesting would assist the company in reducing the cost of water and electricity, which could help to improve the profitability. That is true. 2.6. Escalating in, government interference and threat of additional cost and levy initiation by ESCOM could have negative effects on the profitability of the company. Recently in the news, we've heard that ESCOM is targeting all the customers that are using the solar technology. And that might affect us if we need to pay levies for using the solar panels. What does that mean? It means that even though the cost might be reduced, but it's only going to be reduced in a short run because when we do get the levies, that will simply means that we are now paying higher, because now you have to factor the levies as well. And I think there's no financial projection that have been done in terms of what will this new initiative save the company, which remains a concern. Because if you're coming with a strategy, it is advisable that you also have the financial analysis to say, these are the financial benefit of having the strategy. So there is nothing like that, which raises a concern that the strategy might not have been appropriate for the company to improve its profitability, given the lack of success of company recent Go Fresh strategy. Furthermore, agreement with pay and choose over the resale of laundry detergents will have a negative impact on the profitability. of the company. And then you know where that is coming from. It's coming from the fact that now they had to sell the stock at a cost minus 10%. Then it's threatening the profitability. And that stock, we know it was not going to be sold if they are not moving to an eco-friendly environment, because they were going to continue until the end of the contract in 30 November 2025. Do you see how I recall the date? That is how you need to train your mind, that each and everything that is said, you recall it so that you do not have to go back and read as you answer. Anything that you've read, you keep in your mind and you store it at the back of your mind. That is why when you're going to write your paper, you need to be very flexible. Keep your mind very clean for that day, because it is very important that you remember each and everything. Then either, given the current poor financial position and the cash flow of the company, we need to understand how are they going to finance the rebranding? And will this create the value for the stakeholders?